Hey guys, this is Hydra from Xtrades back with another quick video. And in this video, we're going to cover covered calls and just go over it conceptually. So what is a covered call? A covered call is an option strategy when you own 100 shares of a stock, right? So you need to own at least 100 shares. If you own 100 shares, that's equal to one call option. So 200 is equal to two call options, the 300, three call options, and so on, right? So every 100 shares, you can sell one call option. And when you sell that call option, you generate income in exchange for capping your upside. So what that means, or we'll get into that a little bit more, right? So basically, let's say, right, let's take a look at this example, right? So you own 100 shares of XYZ at $50. You want to sell a covered call. So you're selling a call at a 55 strike price, and the expiration is 1 month from now, right? So this is the strike price, expiration, and you own 100 shares at 50, right? So if the strike price you're selling at is at 55, right? So in exchange for this contract, you are getting something called a premium, right? The premium is what they're going to pay you out per share. So in this example, they are going to pay us out $1 per share. So 100 shares total, right? So $100 total. So what this means is since we are signing this contract, we are getting $100 in total. So there are three scenarios, right? So if the stock goes below 55 by the end of the expiration, you get to keep the premium, so you get to keep the $100 and you still keep your shares, right? If the stock is at or above strike, right? So let's say it closes at 55 or higher, then you have to sell your shares away, right? But you still keep the premium, so you keep the $100 plus you keep the gain from 50 to 55, right? So still really, really good. But let's say the stock falls, so you still keep the premium if the stock falls, but the stock loses value, right? But that's a pretty good worst case scenario because that would have happened anyway if you were just long term holding a stock, right? Um, so yeah, this is really good for generating extra income on the stock that you already own, right? So if you already have long-term stock that you're just planning on holding for the long run, right? If you just sell covered calls, you can make some pretty nice extra income off it. And this is really good for reducing your cost basis. So what that means is basically you're getting $1 per share, right? So if you bought it at 50, effectively, if the shares did not get called away, now your new cost basis after that 1 month is 49 because you got $1 per share. So if you keep doing this over time, you can really reduce your cost basis a lot, right? So it's really, really good for that. And it's also really good when you're trading stocks that are bullish, but like names that won't go up too fast. Because if they go up too fast, for example, if it went up to 60 in a month, right, then you're kind of capping your gains. So you're capping your upside, right? So if it went to 60, you would only keep the gain from 50 to 55. You would miss the gain from 55 to 60, right? Because you sold that contract. So you are capping your upside, but it is really good for stocks that don't move up too fast, right? For stocks that are kind of steady and just go up very, very slowly over time, like Apple, right? So you the strategy works especially well when you are targeting those slower moving stocks that just slow grind up over time. So yeah, the risks trade-off, right? Again, capped upside, as we talked about before, right? So if it went to $60, I wouldn't get that 55 to $60 gain. The downside risk, the stock can fall below the purchase price, but that is normal anyway if you're long-term holding a stock anyway, right? So the downside risk is pretty much very, very limited. And the assignment risk is that your shares might be called away, right? So if the stock goes to 60, you have to sell it at 55 and you lose your shares, right, at that price. So there is that risk. But obviously you are signing the contract, so you are getting a premium for it. It's not like you're just giving them away for nothing, right? Most of the times when you're doing covered calls, you will want to try to sell it at a price where you don't think the shares will get called away. So basically, you're just getting the extra premium for free, right? So again, let's just go over the key terms. Strike price, that's the price that you're willing to sell it at. Income, that's or premium is the income that is received for selling the call. Expiration, the date that the option contract ends. And then assignment, if the buyer exercises the option, you have to sell your shares, right? So normally if it's at the price or above during the expiration day, then you typically have to sell your shares and they will get assigned. So again, let's take a look at one more example. So you have 100 shares of XYZ at 50. You sell a 1 month call at 55 for $1 premium, right? So let's say the stock goes to 48 after the 1 month. So you lose $200 on the stock, but it's unrealized gains. And then you keep $100 premium, right? So if it's at 50, then the stock is at break even, you keep the $100. And if it's at 55, you gain $500 from the stock gain and then $100 from the premium. And then if it goes to 60, then this is kind of like the con of this, or this is kind of the trade-off of the strategy, right? Your gain is now capped at 600 because you can only gain 500 from the stock and 100 from premium max. So yeah, that is the worst part about the strategy, is that your upside is very, very limited, but in exchange you're getting very consistent monthly income every single month if the shares don't get assigned. So again, this is really good for stocks that you're willing to sell, and really good in flat or slightly bullish markets because stocks won't go up too much in a short period of time. And it's really good overall just to reduce your cost basis over time and earn passive income. But yeah, I hope this was helpful. Thank you guys for tuning in.